Welcome back, everybody, to Volatility Trading Strategies. So the topic I want to talk about today, and this actually comes up a lot, I get emails about it all the time, is essentially what is the difference between trading a long put vertical and a short call vertical? Because in the volatility space, we oftentimes associate the higher probability trade as the one on the short vol side of things. So when we hear those names, short call vertical, that's the short vol trade that we're all looking for. And we hear the other one, the long put vertical, we associate that with being long volatility. And of course, that's a lower probability trade. But what I want to do today, I'm going to actually open up my trading software and go through a few examples demonstrating that both of these trades, long put verticals and short call verticals, are actually mathematically the same thing. We're going to dispel the myth that one of them is short vol and one of them is long vol. Actually, they are materially the same trade. So definitely subscribe to the channel if you haven't already. Give the video a like for me, and let me open up my software and go through a few examples. Okay, before I get into showing the verticals, I just want to really quickly point out that there is a Q&A section on the website. There's a Q&A tab here. When you go into it, there's a whole bunch of the more commonly asked questions that I get. And you can always come here and look for quick answers to these types of questions. So this one will probably be number 76 or 77, but it will be in here. There will be a question saying, what's the difference between long put verticals and short call verticals? But just so you know, there is the Q&A section on the website. All right, so let's get into some vertical spreads here. Now what we're looking at here, this is the VXX of the last 1 year. And what we know about these long volatility ETPs is that they do tend to decay over time, so we do want to look for clever ways to short these things. Now vertical option spreads are a really good way to short volatility because they are a defined risk trade and they don't really need any additional hedging. They do require some good capital management, but as long as you're not overexposed, vertical spreads are a good way to short the VXX or the UVXY as they decay down over time. But the big question is, which is better, the long put vertical or the short call vertical? And since we've got VXX here closing at 1751, it was actually 1749 in the aftermarket print, but that's going to be very close to the strike price, so it gives us a very good opportunity to compare these two types of trades. So I've already inputted some trades here to speed things up a little bit, but right here, this little hash line, you can see that's at 1749. Now the first one we'll look at down here is this long put vertical right here. We can see it is long the 1750 put, and then it is short the 1650 put. So with today's price right there, it actually has to move downward into the profit range. So we can put this little thing at 1650, and the price actually has to go down to there to reach the maximum profit, which in this case would be $38 for this spread. And now we can compare this one to the short call vertical, which in this case, we are short the 1750 call, and then we are long the 1850 call. So this does seem like a better trade on first glance, doesn't it? We've got the price right here, and all we really need is for the price to stay here or go down a little bit, and we can reach the maximum profit. The price actually has to go up substantially in order for us to lose money. So when we're comparing these two things, the gut reaction is to say that, well, clearly the short call vertical is the better trade. We don't require any movement to make a profit, whereas the long put vertical, we actually needed it to move down. But there is a couple of things to note here. The first thing is, the maximum profit for this trade is $27. Now it's true that it happens at a lower point, but you have to note that the maximum gain and the maximum loss aren't quite as attractive as the long put vertical here, where the maximum loss was only 62 and the maximum gain was 38. So the risk-reward profile of these two trades is slightly different. But the second thing we have to note, you can see down here, these are actually trading different strike prices. For this one, we're using the 1750, 1650, and for the short call vertical, we're using the 1750, 1850. So when we're comparing these two trades, they're not quite the same thing. We're not comparing apples to apples here. So now again, because it's at 1750 and we can see the strikes, we've got a 1750 strike here. VXX does tend to be a pretty liquid product, and there's lots of contracts being traded on both sides. But because the price is right there on the threshold, it does give us a good opportunity to compare here. So we're going to do two other trades here. The first one is again a long put vertical. This time around, we're long the 18 and we're short the 17. So I'm going to actually move these hash lines over close enough to the edges. So the max gain is going to be at $17 or lower, and then the maximum loss is going to be at $18 or higher. This is a long put vertical with today's price right in the center of the trade. So we can see that if the VXX over the next 1 month does nothing, this trade would actually lose a small amount of money. It would lose about $15. But now if we want to do the short call vertical using the same strikes, now we can short the 17 call and we can buy the 18 call. So we are short the 17, below that is maximum gain, and then we're long the 18. That makes it a defined risk trade, and above 18 is the maximum loss. But again, you can see here, today's price is right there in the center, and if VXX doesn't go anywhere in the next month, then this trade will also lose $15. And looking further than that, you can see 67-cent premium on the long side and 33-cent premium collected on the short side. This is identical on both sides. This is just a mirror image of each other. And to go even further than that, you can see that it is exactly the same trade. Maximum gain at $33, you can see that right there. So when I hover anywhere over this max gain, we'll make $33. And that happens at 17 or less. And then we can lose $67, 18 or higher. If we go down to the short call vertical, it's the exact same thing. Below 17, we can make a max of $33, and we can lose a maximum of $67. Absolutely identical in both cases. And this is really what I wanted to showcase today, is that when you normalize things for using the same strike price and the same risk-reward ratio, these trades are the same. Just because one of them is short and it's bringing in a premium of 33 cents, and the other one is long and you're paying a premium of 67 cents, these are not different trades. We can check the Greeks really quick just to confirm that. Here's the long put vertical, and we can see that our theta is positive, 41 cents there, and our vega positive at 5 cents. Now we can go to the short call vertical and we can see the same thing. The vega is 5 cents and the theta is going to be that same 41 cents. In every way, these are mathematically identical trades. Now there really is only one difference with these two trades. So if we first go to the long put vertical again, we can see that the short strike that we're using is that 17 put, which is over here. Today's price is right there, which means that 17 put isn't in the money yet. It's out of the money. However, if we go to the short call vertical, the short strike in this case is the 17 call, and then we're long the 18. But this 17 call is actually in the money a little bit. Now, of course, this will depend on what strikes you choose, but typically the way people trade these types of vertical spreads, quite often the long put vertical will start with that short strike not being in the money. And the short call vertical will start with that short strike already being in the money, or at least a lot closer to the money. It's just how these two trades are built. Now, it's not a big deal. It's actually quite rare for people to exercise their VXX trades early in the cycle. But it is something to keep in mind that the probability of early assignment does go up a little bit when you have short strikes that are in the money. If it was just a straight choice between two materially identical trades, there's really no reason to not build them where the short strike isn't yet in the money. Again, VXX, UVXY, not really a big deal, but if you're trading something like the SPY or different individual stocks, and especially if there's dividends involved, you really don't want your short strikes to be in the money because that does introduce the possibility of early assignment. But again, the point of this video was just to show that these two trades are basically the same. So when we go to that first example that I showed, of the apparently much more attractive looking short call vertical here, we can also recreate this trade with the long put vertical. So all I have to do in that case is basically use the different strikes. I'm now long the 1850 put and short the 1750 put. And now this is exactly the same. The price just has to stay here or go down and it's going to be a profitable trade. Now there is a 1 penny difference here, but that's basically just how the computer is matching up the contracts. In live trading, in a real situation, these will be identical trades as well. There really is no volatility component when you're trading verticals with strike prices that are fairly close to each other. It's mostly eliminated and it's just about whatever's in between those strikes, which is basically negligible. So there you go. As you can see, they are basically the same trade, and you can use them at your discretion based on where the strike prices are and also just your general preferences. But we definitely do need to dispel this myth that one of them is short vol and one of them is long vol. That is just simply not true. These are mirror images of each other. If you use the same strikes, it is the same trade, so you can use them interchangeably. So for me personally, I'd say I'm about 70-30. I probably do default more often to the long put verticals. But of course they are identical, these are mirror trades of each other, so short call verticals are just fine as well. Now for me, of course, because the UVXY and the VXX do trend down over time, I typically position them to where I expect the price most likely to be, say a few weeks in advance or through the monthly cycles. So those long put verticals, I will have the price a little bit further out of the money, expecting the VXX or the UVXY to move into that range. And that's why I do like to keep those short strikes a little bit further out, but that's just a personal preference. Again, these are the same trade. So now that you know that, you can basically trade them interchangeably, whatever suits your personal situation. So make sure to check out my website. There's tons of volatility metrics on there. There's articles, videos, and of course, claim your free trial to the VTS community. You can sign on for a couple of weeks. You can see our live trades and see if this is something that's suitable for your long-term investment goals. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.